Let's start with the money debt economic cycle. We had this extended period of what you've called insanely low interest rates, followed by a massive wealth transfer that happened during the pandemic. Where does that leave us when you look at the economy over the next couple of years with the buildup in debt, with interest rates returning to normal? What does the economy look like?
Yes, I like to explain when I answer questions like that, I like to explain the mechanics of how it works so that we understand.
As long as we can do it within the time.
And I'll try to be as quick as I can. One man's debts are another man's assets. That means interest rates have got to be high enough that they're a good return for the creditor without being so high that they're bad for the debtor. And so you see these swings and cycles in which it's great for one time for the debtor and vice versa. So we went into an insanely free money environment in which interest rates were nil and real interest rates, bond yields, went to minus 1.7%. Okay, so which side is it good for? Okay,
yeah.
Okay. And then we go through this other swing, an insane swing. All through this, we've increased our debt to GDP. What we did is we particularly transferred, the government got into a lot of debt, and the government then wrote so that they could write a lot of checks for a lot of things, okay? So what happens is, as debts rise relative to incomes that are supposed to support the debt, it becomes a more and more difficult balance. So we've reached the point, we are reaching the point in a classic debt cycle, you reach the point that you have to borrow to service your debt. You know, like the different countries, Singapore is a good example, 20% of their expenditures, for government expenditures, come from what they earn in the financial part of their balance sheet.
Right.
Well, there's the other side of that of what you
have
pay.
to pay debt. Okay.
And then there's that acceleration. So we're very close to that acceleration in which it becomes compounded. And there's I won't spend too much time, but the classic signs are when the central banks lose a lot of money. So what happened is they bought all the bonds because there was a supply-demand imbalance.
Yeah.
In other words, there were not enough buyers.
Yeah.
So they came in and bought on. So they messed up the market, the free market, to keep rates there.
Yeah.
And now they're owning all the bonds. Banks bought all the bonds. Japanese bought bonds. Everybody bought bonds. They have a lot of bonds. They're losing money on the bonds. Everybody's, okay, go
So
ahead.
you've watched this cycle over 500 years. What does that mean for the next year or two?
Well, what it means is that all markets are driven off of the Treasury market.
Yeah.
All credit markets, all equity markets, everything is priced off of that curve. So now we'll go back to basics of that. What is the inflation rate going to be, estimated inflation rate? And people have their different guesses. Probably between 3 and 4%, okay? Somewhere in let's call it 3.5, whatever the number is. You're going to need a real interest rate that's going to be in the vicinity of 1.5 or 2%. You can't go back to the other way.
So now you're talking 5.5.
So you're talking in that order of neighborhood, 5.5. There's nothing precise about that. And so now you have an interest rate that is in that vicinity if you have a normal supply-demand issue. We may have a supply-demand imbalance. We're going to be dealing with that because there will be still big deficits. The world needs big spending. There's going to be big spending. And that means you have to sell bonds. And the world is overloaded in bonds, and so we have that dynamic. So I don't believe that you're going to see any material interest rate decline. A lot is being made of the blip down. Interest rates went from, the bond yield went from 1.7% to 5%, and has then come down to 4.5-ish, and so on. But so that is where the bond. Now, when you're looking at, let's say, equity markets, and they can be private or public equity markets, and you're looking at the premium that they usually should have above that, you don't have much premium above that. At the same time, you're having this technological changes that are big technological changes. And so the question has to do with, what their impact is on earnings and so on.
So it's sort of, do the negative economic effects outweigh the positive technology effects?
Yeah, you have to look at company by company and industry by industry, and also geography by geography, because there's such a bias to talk about the American markets.
Yeah.